Hi everyone, and welcome to the new series which I'll call Mispriced Product Alert. I didn't have a chance to record a video about this earlier, but this will be a series in which I'll mention some contracts which are not really priced or how they should be. Just to mention some mispriced products from this year. Earlier this year, around February, I think, there were mispriced options on FTX. They were introduced on FTX, and the implied volatilities were just way too low, significantly lower than those on Deribit. So at that point, purchasing as much as you can with the highest kind of volatility component and lowest in the money component was the best. So buying wingy options was great. Then at some point it was BitC exchange having completely wrong futures premiums. Now I have some reservations and trust issues with BitC, but when a product is so much cheaper than the competition, it was reasonable to buy futures there. I believe these were June futures at that point, and sell futures somewhere else. Other opportunity that I have mentioned on my Twitter was Ethereum Classic trading completely differently on Coinbase in US and anywhere else, and then the rest of the world closed to the price traded at Coinbase. And today I'll be talking about the implied volatilities on Ethereum being too low, but they were actually a little bit too low for Bitcoin as well. So here's my series of tweets in which I have mentioned this. So to start with, it's good to look at the past. So the Ethereum at the money implied volatility was around 86% before the big dump, and that big dump has shifted a lot of liquidity has left the marketplace, the implied volatilities have skyrocketed. So the baseline before that, there wasn't much price action before it. It was just a slow decline. So the baseline for Ethereum implied volatility to me is around 80%, and that's the good price to buy volatility if there are no confounding factors. And for Bitcoin, I would think around 60 to 70% is a good buy. However, these implied volatilities have contracted really a lot. So I'll just share my thoughts with you. I have finally managed to fully open my long-term position, mainly a December expiry Ethereum calls, but also some puts. And you buy puts just to create the synthetic call. So you wouldn't normally go long Ethereum. You wouldn't go too long just in case the market goes against you. But if you can buy a cheap put to protect you, then it's fair game. So Ethereum long and short-term volatility was 86% before the big dump on the 12th of March. I consider that cheap. We have now dropped well below that with asks at 85% currently. And that was even before this contracted even further. I've been patiently waiting for long-term Ethereum and Bitcoin December expiry volatility to drop. Over the past few days I was getting some fills, but now someone sold loads and pushed implied volatility so it pushed it down so much that I have what I wanted. It took 2.5 months, honestly, and I was not sure whether it would happen at all. Now, why am I looking at December expiry volatility? First of all, we are in a very volatile time. We have entered an extremely uncertain time with lockdowns coming towards an end, money printing, unemployment, gold, and stocks are at their highs with interest rates around 0%. Bankruptcies will soon hit all-time highs. Stocks might get volatile, and US elections in November might change some things. Until elections, I believe the financial assets will have a tailwind with Trump kind of pushing Fed to print more money. So I've been eyeing both ETC and Ethereum volatility because, strangely, Ethereum volatility is now on par with Bitcoin implied volatility, so I went for ETH. It should be significantly higher in my opinion, so the implied volatility on Bitcoin and on Ether, I will zoom up maybe on this period of time. So let's focus on the long-term volatility. So the 3-month volatility was 77% on Bitcoin, and it was 78% on Ethereum. I mean, Ethereum is so much volatile. You are not only having volatility on the Bitcoin USD side of things, but also on the Bitcoin ETH side of things. So to me, Ether should be more volatile. Why? I have mentioned, so there is smaller supply, smaller and less efficient markets, massive open optionality. Ethereum 2.0 will lock 30 to 50% of supply with no selling until 2021, maybe 2022. Ethereum 2.0 might come later this year, but it actually may be delayed till 2021, so it's hard to guess. Okie doke. So I've got majority of my fills here, and these are mainly calls. I expect Bitcoin to go up because of the halving, and I expect Ethereum to go up because of the Ethereum 2.0 locking and staking and removal of supply. Also, Ethereum will be quite useful once the Ethereum 2.0 rolls out completely. So actually, my tweets were around this point when the volatility has dropped significantly, and that was around where exactly was that? That was 18th of May, 25th of May. Yep. Just after 25th, so that was this period of time. Yeah. So the Ethereum long-term volatility has picked up since then, but I suspect there will be some further opportunities to buy cheap ETH and cheap BTC volatility. Now, what can you do with this volatility? At that point in time when ETH was reasonably cheap, on 25th, it was before the big pump, it was around 200. Now it's around 240, so it's less of an opportunity to buy, but because of the implied volatility still being low, you could use that implied volatility to buy some puts. So if you are a bull, you might use that volatility if we have a retracement, a pullback, or maybe you just want to still go in because the volatility is still not that expensive. But because we've had the price going up, it's reasonable to look at the puts this time, partially because a lot of people are actually now buying calls as we went up. So this is a skew. The skew went down from being very positive, which means people are buying puts, to very negative, which means people are buying calls. So to sum things up, the implied volatility on Ethereum is a particular good opportunity. I think it's too low. It should be higher, and it's a good buy opportunity to buy calls and puts, especially long term. I think the implied volatility on Bitcoin is not so attractive, but it's still attractive. At that point in time, I was very interested in buying calls at the price of 240 per Ether. I would be less interested. But I would be more interested at some point when we have massive funding, massive futures premiums in the range of 20-30% per year. At that point in time, I would be interested in buying puts, so this is the opportunity. But if the price retracts back to maybe 200, then that would be a call opportunity. Obviously, this is not a financial advice. This is just me thinking loudly. I could be completely wrong. Thank you very much for watching, and please like, comment, and subscribe. I will give you further updates if there are any market kind of irregularities, mispriced products, which I'm happy to share with the rest of the world. Thanks for watching.